As I'm recording this on February 19th, 2026, gold spot is up over 1.6% on the day, trading right around $4,956 per ounce. Silver is up nearly 6%. Brent crude is pushing back towards $70 despite a market that was supposed to be drowning in supply. And there are now 2 American aircraft carrier strike groups, either in or heading toward the Persian Gulf. 4 separate facts. By the end of this video, you are going to understand exactly why they are not separate at all. Welcome to the channel. We track what is actually moving money in these markets and cut through the noise so you can think for yourself. If that is useful to you, hit subscribe and give this a like. It genuinely helps more people see this content. And right now, this is a conversation more people need to be having. Let's start with gold, because today's rebound does not come out of nowhere. On January 31st, 2026, gold plunged over 12% in a single session. Silver fell as much as 36%. The trigger, according to analysts, was the nomination of Kevin Warsh as the next Federal Reserve Chair, which markets read as a hawkish signal combined with a simultaneous hike in CME margin requirements that forced leveraged traders to liquidate positions fast. Let me translate that. The paper market got squeezed violently, but the physical demand underneath did not disappear. Gold has since reclaimed the $5,000 level and is now consolidating right at that threshold, with Ole Hansen of Saxo Bank identifying support at 4,860 and resistance at 5,140. The reason that physical floor holds is central bank buying. According to the World Gold Council, global central banks purchased 1,037 tons of gold in 2025. China, India, Turkey, sovereign governments systematically reallocating reserves away from US dollar exposure and into physical gold month after month. When buyers with trillion-dollar balance sheets are that consistent, the price floor stops being a technical level and starts being a structural reality. That is why every violent paper market correction in gold over the past 2 years has been followed by a recovery. The buyers underneath are not day traders, they are governments. Now oil, because this is where the picture snaps into focus. Brent crude was supposed to average around $62 in 2026, with major banks projecting a global supply surplus of roughly 4 million barrels per day. JP Morgan had even floated scenarios where Brent falls into the low 30s. Against that overwhelmingly bearish supply backdrop, oil is going up. Something is overriding the fundamentals. That something is the Strait of Hormuz. Axios reported this week, describing it as a top story that the Trump administration is closer to a major war in the Middle East than most Americans realize. And that, according to their sources, it could begin very soon, likely as a massive week-long military campaign. The military positioning backs that framing. On February 13th, President Trump confirmed he was ordering the USS Gerald R. Ford, the world's largest aircraft carrier, to leave the Caribbean and head toward the Middle East, joining the USS Abraham Lincoln Strike Group already operating in the Arabian Sea. 2 carrier strike groups, the most significant concentration of American naval firepower in that region in close to a decade. Trump himself said, "In case we don't make a deal, we'll need it." The Strait of Hormuz is the choke point through which approximately 1/5 of all global oil supply passes every single day. Iran has stated it could mine that strait and target regional oil infrastructure if hostilities escalate. Markets are not pricing the certainty of war, they are pricing the rising probability of it. And that repricing is showing up simultaneously in oil and in gold. Look at these pieces separately and they each have an explanation. Gold recovering from a technical correction, oil moving despite a supply surplus, military assets repositioning, Central banks buying physical gold at record pace. Look at them together and they tell you one thing: the market is repricing geopolitical risk in real time. And gold above $5,000 is the price of insurance in a world where a week-long military campaign in the Middle East is reportedly closer than most people realize. Silver adds another layer to this. Hansen flagged that silver suffered a 61.8% Fibonacci retracement of its entire April 2025 to January 2026 rally, falling from $121 all the way to around $73 during that forced liquidation event. For the outlook to turn constructive again, silver needs to reclaim $86. But the structural picture for silver is arguably more compelling than gold's. 5 consecutive years of global market deficits, cumulative shortfalls of approximately 820 million ounces between 2021 and 2025. Silver lease rates, the cost to borrow physical silver for near-term delivery, reportedly hit 8% in January 2026, compared to a historical norm of less than 0.5%. When it costs 8% annually just to borrow silver, the physical market is telling you something the paper price has not yet fully reflected. What happens from here depends on decisions being made in Washington, Tehran, and Tel Aviv over the coming weeks. If the Iran situation de-escalates diplomatically, safe haven demand pulls back, and both gold and oil face headwinds. If it doesn't, if those carrier strike groups are being positioned for something, the supply assumptions underpinning the $62 Brent forecast become irrelevant overnight, and the conditions that drove gold to $5,000 intensify further. Watch the Strait of Hormuz. Watch whether gold closes and holds above 5,140 on a sustained basis. And watch silver if it reclaims $86. Hansen says the outlook turns more constructive, and given those lease rates, the physical reality may eventually force the paper price to catch up. Here is my question for the comments. Given that silver lease rates reportedly hit 8% in January 2026 against a historical norm of under 0.5%, at what price level do you think the physical supply squeeze finally forces a genuine repricing, and does it happen before or after the Iran situation resolves? Put a number and a time frame down below. I want to see what this audience thinks. If this breakdown gave you something useful, send it to one person who follows commodities or geopolitics. One share matters more than you think, and if you are not subscribed yet, now is a good time to fix that. Until next time, stay informed, stay prepared, and we will see you in the next video.